Greetings from MWN.com. Dr.M.Wilson, formerly Vice Principal and Head of Department of Commerce, Scott Christian College, Nagercoil is delighted in presenting this session. Thank you. Please subscribe the channel MWN.com. Principles of Double Entry System. Double entry system was first introduced by Luca Pacioli of Italy in the year 1494. According to this system, every transaction is divided into two aspects. One aspect of the transaction is called debit aspect and another aspect of the transaction is called credit aspect. Hence, every transaction will be recorded in two accounts. For example, a transaction, wages paid for 70,000 rupees, should be divided and recorded into two accounts, namely, wage account and cash account. Since every transaction has debit aspect and credit aspect, total debit transactions will be equal to the total credit transactions of an accounting period. Hence, double entry system may be defined as a system of accounting in which the transactions are divided into debit aspect and credit aspect and recorded into two different accounts. Meaning of debit and credit. The word debit is derived from the Latin word debitum, which means do for that. The word credit is derived from the Latin word creditor, which means due to that. Rules for the double entry system. The accounts are classified into three categories: 1. Personal account, 2. Real account, and 3. Nominal account, for the convenience of writing the two aspects of all transactions into two different accounts. The rules of debit and credit differ for these three accounts. 1. Personal account. Personal account records transactions connected with a person or firm, that is, natural person and artificial person. A person or firm may buy or sell goods from the business, receive or pay loan to the business unit. Hence, the person may either be a giver or a receiver. If he is a giver, his account is credited. For example, if X sold goods for 90,000 rupees to a business, X is called the creditor giver and X's account is credited. If the person is a receiver, his account is debited. For example, if Y purchased goods for 30,000 rupees from a business unit, Y is called the debtor receiver and Y's account is debited. Hence, the rule for personal account is debit the receiver and credit the giver. 2. Real account. Real account is an account for recording the real thing, otherwise called assets. Assets may either come into the business or goes out of the business. When assets come into the business, the asset account is debited. When assets go out of the business, the asset account is credited. Hence, the rule for real account is debit what comes in and credit what goes out. 3. Nominal account. The account which records transactions like income, expenses, profit and losses is called nominal account. Income and profit are credited, and expenses and losses are debited. For example, salary paid for 75,000 rupees is debited in salary account and commission received for 39,000 rupees is credited in commission account. Hence, the rule for nominal account is debit the expenses and losses and credit the income and gains. The accounting rules can be summarized as follows. 1. Personal account. Debit the receiver and credit the giver. 2. Real account. Debit what comes in and credit what goes out. 3. Nominal account. Debit expenses and losses and credit income and gains. Accounting equation. The relation between the asset of the business and the proprietor's capital and the liabilities is called the accounting equation. It can be represented as follows. Assets equals equity, or assets equals capital plus liabilities. A business receives the capital from the proprietor, and purchases fixed assets and keeps some portion of the money for day-to-day expenses. Hence, the total assets would always be equal to the capital. Example. A proprietor invested 10 lakh rupees in a business. If the amount is utilized for the purchase of fixed assets like land and building for 5 lakh rupees and machinery for 3,50,000 rupees, the balance cash would be 1,50,000 rupees. It can be represented as assets. Land and building 5 lakh rupees plus plant and machinery rupees 3,50,000 plus cash 1,50,000 rupees equals capital 10 lakh rupees. The business can borrow funds from outsiders for acquisition of assets and for working capital purpose. It is called the liability. Therefore, the capital and the liability should be equal to the total assets of the business. Accounting equation accommodates assets, liabilities, capital, income and expenses. The income and expenses are recorded in a separate account called the profit and loss account. The net effect of the income and expenses is transferred to the capital. If there is excess income over expenses, it is called net profit and it is added to the capital. If there is excess expenses over income for a period, it is called net loss and it is deducted from the capital. In this way, the condition of accounting equation will be satisfied. The accounting equation is recorded in a statement called balance sheet. Since the net effect of all the debits and all the credits is recorded in the balance sheet, the assets side and liability side of the balance sheet are equal. Rules of accounting equation. The rules of accounting equation are as follows. 1. Debit increases the assets and credit decreases in the assets. 2. Debit decreases in liabilities and credit increases in liabilities. 3. Debit decreases in capital and credit increases in capital. 4. Debit increases in expenses and credit decreases in expenses. 5. Debit decreases in income and credit increases in income. Procedures of double entry system. The procedures of double entry system are 1. Recording in journal, 2. Posting into ledger, 3. Preparation of trial balance, and 4. Preparation of final accounts, trading and profit and loss account and balance sheet. 1. Recording in journal. Journal is otherwise called subsidiary book or book of original entry. The transactions should be recorded first of all in the journal. All the transactions should be classified into two aspects and they should be debited and credited in two accounts. For example, sale of goods for 5 lakh rupees can be recorded as follows. Cash account debtor 5 lakhs. To sales account 5 lakhs. The process or recording the transactions in journal is called entering. 2. Posting into ledger. Ledger is otherwise called primary book. All the transactions recorded in the subsidiary book journal should be posted into the respective accounts in the ledger. Hence, a ledger is the collection of different accounts. The accounts may be like salary account, purchase account, cash account, Jane's account, etc. These accounts are named as real account, personal account, and nominal account. According to the principle of accounting, these accounts are debited or credited. For every debit in one account, there would be corresponding credit for the same amount in another account. 3. Preparation of trial balance. Trial balance is a statement of all balances of accounts of a ledger. It contains debit and credit columns and column for writing the accounts. All the accounts should be recorded in trial balance with respective balances which can be written on debit or credit column on the basis of the debit balance or credit balance. 4. Preparation of final accounts. Final accounts mean 1. Trading and profit and loss account, and 2. Balance sheet. These accounts are prepared from the balances of different accounts of the ledger. These balances can be easily located from the trial balance.